So let me ask you something. Are you building wealth the right way? A lot of people get really excited and jump into investing, but they get the order all wrong. And that one mistake can quietly cost them tens, even hundreds of thousands of dollars over time. In this explainer, we are going to lay out the exact blueprint, the smartest order to invest your money.
You know, investing while you're carrying high-interest debt, it's just like this. It's like trying to fill a bucket that has these massive holes in the bottom. You can pour all the money you want in at the top, getting excited about your potential gains, but a huge chunk of it is just leaking right out as interest payments. You feel like you're working hard, but you're just not getting ahead.
And here's the size of one of those holes. The average interest rate on a credit card is a staggering 22%. Now think about that. This isn't a potential loss. This is a guaranteed mathematical drain on your money. It's like a financial cancer, and it grows way faster than any reasonable investment you could ever hope to make.
Now, let's contrast that huge debt burden with this number. The median emergency fund for an American is just $500. That's it. That barely covers a car repair or a surprise medical bill. So for so many people, this is the reality. A tiny, tiny safety net and a massive guaranteed financial drag. I mean, that's just a recipe for disaster. And this gets us right to the core of the problem. People are investing in the wrong order. It's like building this beautiful, amazing house, but you're completely ignoring the fact that the foundation underneath is cracked and totally unstable. It doesn't matter how fancy the house is on top, the whole thing is at risk of crumbling.
And here's the thing. People jump to the exciting stuff, right? Stocks, crypto, whatever the next hot thing is, because it feels like you're making progress. But for every single dollar that's just sitting in a 22% debt, you are guaranteeing a 22% loss every single year. Not even the best investors in the world can consistently beat a guaranteed loss of that size. It's just not possible. So how do we fix this? Well, we have to start with the foundation. This is the boring, unglamorous work. You know, it doesn't make for exciting headlines, but it is absolutely essential if you want to build lasting wealth. These are the non-negotiable first steps. And here they are. It's pretty simple, really. First, you build a safety net. This is what protects you from life's little curveballs. You can start with a goal of, say, $1,000 or $2,000. Studies show that even just having that much gives you a massive psychological boost. And once that's in place, you declare war on your high-interest debt. We're talking anything over about 8%. And here is the smartest weapon to use in that war, the debt avalanche method. It is mathematically the most efficient way to get out of debt. You just pay the bare minimums on everything else, and then you throw every extra dollar you have at the one debt with the absolute highest interest rate. Once that one's gone, you take that whole payment and you roll it onto the next highest one. This strategy saves you the most money in interest, period. Okay, so there is one giant exception to the pay off all your debt first rule. It's a step that is so powerful, so important, that it's worth hitting pause on your debt avalanche for. And that's because it's literally free money. So let me ask you this. What could possibly offer a guaranteed return that's so high that it actually makes sense to grab it, even while you still have 22% credit card debt? I mean, the stock market can't guarantee that. Real estate can't. But there is one thing that can. And it's your employer's 401k match. The math on this is just, it's undeniable. On the left, you've got that guaranteed loss. But on the right, if your employer matches, say 100% of your contributions, up to 3% of your salary, you are getting an immediate, guaranteed 100% return on your money. No investment on earth can beat that. So the move is, contribute just enough to get the full match, then turn right back around and keep destroying your debt. All right, once your high interest debt is gone and you're getting your full employer match, you get to enter what I like to call the tax optimization zone. This is where you level up. You strategically use special accounts to let your money grow while keeping as much of it as possible away from Uncle Sam. So the big decision you have to make here is between traditional and Roth accounts. A traditional account gives you a tax break today. A Roth account gives you totally tax-free withdrawals in retirement. So what's the general rule of thumb? Well, if you expect to be in a higher tax bracket in the future, which, let's be honest, is true for most young people, the Roth is probably your best bet. You pay the taxes now while your rate is lower. Now, if you are eligible for a health savings account, an HSA, you have unlocked what might just be the most powerful investment vehicle in America. Seriously, it's the only account that has a triple tax advantage. Your money goes in tax-free, it grows tax-free, and it comes out tax-free for medical expenses. It is an absolute powerhouse for building wealth. So for 2025, here's your investment waterfall. Once you've got the match and the debt is gone, the money flows just like this. First, max out your HSA if you have one. Then you max out your IRA. Finally, you go back to your 401k and you fill that all the way up to the limit. If you can manage to do all of this, you are in the absolute top tier of savers in the entire country. You're crushing it. So, only after you have maxed out every single tax-advantaged option that's available to you, only then do you move to the final frontier, the standard taxable brokerage account. You know, this is the step most people want to start with, but it should actually be the very last thing you do. And here's why. Taxable accounts suffer from this thing called tax drag. Every time your investments pay out a dividend or every time you sell for a profit, the IRS takes a cut. It's this constant, slow leak that just erodes your long-term returns. It's like trying to run a race with sandbags tied to your ankles. And here's what that costs you in the long run. Just look at this. Over 30 years, that tax drag can be absolutely devastating. The exact same investment could be worth nearly $250,000 less simply because it was held in the wrong type of account. I mean, that is the power of tax optimization.
Okay, we've covered a ton of ground, so let's put it all together into one clear, actionable blueprint. This is the smartest path forward. This is the exact sequence you should follow to build your financial house on solid rock.
Here it is, the optimal investment order. Step 1, build your starter emergency fund. Step 2, get your full 401k employer match. You never leave free money on the table. Step 3, eliminate all of that high-interest debt. Step 4, max out your HSA. Step 5, max out your IRA. Step 6, go back and max out the rest of your 401k. And only then, finally, do you move to a taxable account. If you follow these steps, your future self is going to thank you.
So I'll leave you with this one question to think about. Take a good, hard look at your own strategy. Are you following a logical sequence? Are you building that strong foundation first? Or are you getting distracted by the exciting new thing while your foundation is cracking? Is your financial house built on solid rock, or is it built on quicksand?